Hey guys, welcome back for another quick message on this particular platform. And as always, I am grateful for all of the subscribers who've taken the time to grow and sit under this ministry work here on this particular platform. As always, we will start with our verse of the week, which is none other than Isaiah 49:16, which is a reminder that you are in the palm of our Father in heaven's hands. That's right. You are placed and positioned in his hands. So remember that as you go through the week, whenever you have struggles or trying times, just recall that and reflect on that. And so our message for today is surrounding a different area of expertise. This time we're talking about home ownership. And so with that, a lot of people just are not aware of what they should be doing as it relates to home ownership. And so you don't ever want to allow chasing a dream cause you to lose something that you've worked so hard for. And so, yes, while many people do have the dream and the desire to have a home and to own it, it's a lot of different things that you should understand when it comes to home ownership. It's not as simple as, yes, just paying your mortgage on time and things like that. So, for example, you know that when you rent, you typically have expenses that are going to come and that are going to be factored in to your rent, such as your trash, such as your internet, such as your cable, such as your water or your utilities and things like that. And maybe even the amenities, there may be a fee for that if you are in a more luxe scale circumstance or situation within your renting. However, with a mortgage, if you're in an HOA, that means homeowners association, you are going to be required to do certain things a certain way. So that is one thing that you need to be aware of. You're going to be required to do things a certain way. You're going to be required to keep your lawn a certain way. You're going to be required to keep your house color a certain way. You're going to be required to get authorization to make any type of alterations to your home. And I can give you this information because my very first home with my husband, we purchased into a homeowners association, and we couldn't understand why we like thick grass. But at the same time, if it was 2 inches too high, you can get a fine for that. And so those are things to consider. So it kind of goes in hand with one of the previous messages I released, which was, have you considered the things that you desire or that you're praying for? Do your research and see if this is something that you are going to be able to keep in tune with, because you wouldn't ever want to put yourself in a situation or a circumstance that is going to make you fall outside of the alignment of being able to receive what it is that you're capable of receiving. And so do your research. But with the HOA, such as those factors, that's going to be something that's going to be considered within your mortgage. And then on top of that, you have taxes, property taxes. That's another area that's really overlooked when it comes to home ownership. When it comes to home ownership, you have to search around just like you would for your car insurance to make sure that everything is covered, from your roof to your foundation is not going to be covered. That's a whole nother different story. But from your roof to just minor things that, like, such as your detached structures and things like that. But you have to make sure that those things are covered, and you don't get to determine the price point of what these things are going to cost. I can just tell you from our most recent purchase, it just, your taxes can be skyrocketed. It kind of fluctuates with the market value. And so the economy, all of that is going to be a contributing factor as to how your homeowners insurance is going to raise. And if you have that as a part of your mortgage, considered as a part of your escrows, things that are paid for on a monthly basis within your mortgage or incorporated into your mortgage, then this is something that could cause your mortgage payment to balloon or skyrocket, elevate, increase rapidly. And so with that being said, you want to make sure that you are aware of these things. So it is very imperative that you do your research, you understand all of the aspects that are going to be incorporated into your loan, or things that you're going to be required to be responsible about when it comes to home ownership. And so when you do your research, it's imperative for you to find out these things for yourself. So while some realtors are great, some are just like car salesmen. Some are out to just get a check. Some are just commission based, and they are really just out to make a deal at the end of the day. So while you think of your realtor as that go-to person or that person that really cares and has a heart for their work. No, a lot of the times they're not. This is their role. They don't eat if they don't get a deal, especially if they're commissions based, which most of them are. Now, granted, there are some exceptional realtors, and mine happens to be one right now. Yes, Miss Jenkins, you are fabulous. But at the same time, you definitely want to make sure that you have a realtor that does understand what it is that you're trying to execute or accomplish, and taking those things seriously, because like I said, a lot of the realtors that are working out here are not in it for you to have what's best for you. The higher the value of your house, the higher their commission, because it's a percentage of the actual sales price. And so diving into that, that's another component of it. When you've saved money to be able to purchase this investment, because that's what a home is. A home is an investment piece. It should be something that still is going to warrant you a source of income from itself. And so you have to consider that. How can my home make me money? How can my home earn me interest? How can my home do all of these different aspects? Do you have land? Can you potentially start a small farm? Can you do devotionals out of your home? Do you all different ways that you can actually profit from your home, or be able to utilize it as something that's being fruitful. So it doesn't have to necessarily be monetarily, but how is it going to profit you? And so you have to take that into consideration as well. And so when it comes to the price point, that's something that's going to be incorporated. Your sales commissions. And so when you sell your home, you're going to have to pay whatever that percentage is that's going to be agreed upon between you and your realtor. And so when you are agreeing on that term, I don't care if the house sells for very little, you're still going to be responsible for selling, for paying out of your net proceeds, which is the portion of the sale that's left over after you have completed, the payment to the actual builder or the previous homeowner, should you buy a pre-existing home. And so there are different types of homes that you would look at on the market. That's another area that you want to consider and do your research on. A pre-existing, you have a little bit more flexibility because it would be a property that someone has already resided in. However, if it's a new build, you don't have as much room for negotiation when it comes to the price point or negotiating certain things. Now, in a buyer's market, then you typically do have the ability to ask for certain things, such as incentives, such as seller concessions, which is going to be something that the seller offers to the buyer to make it that much more appeasing or manageable for the actual buyer. Then the next component is going to be like your fees that are associated before you even get into the home. Before you even get into the home, you have appraisal fees, you have inspection fees, you also have your earnest money. And all of these different factors are going to be determined on your location, the price point of the home, the builder, and then the requirement of the lender. So you have to make sure that you're aware of all of these different aspects and not just go for a home because it looks like it's the right price, because it's in the right location. Look at your lender, look at their practices, do your research, do your homework surrounding these different aspects and areas, because you don't want to get mixed in with something that you don't understand to its entirety. Ask questions. It's an investment, guys. This is not a small amount or small portion of your hard-earned income. This is why the Proverbs 31 woman considered the field before she bought it. And so, yes, all things are scriptural on this particular platform. Yes, so that's our tie-in piece. You have to consider the things that you desire. Have you considered it? Do you know? Are you educated? Do you have the wisdom? Do you have the discernment? Are you at a point in your life that you should be considering such things? Are you in alignment? Are you outside of alignment? A lot of different factors should go into this. And are you praying and seeking our Father in heaven daily for his instructions as it relates to this investment? Because he should not be left out of this either. And so learn the different types of loans. That's the next point. The next point is learn the different types of loans, because you have FHA loans, which are first time home buyers, and there are different guidelines as to how much you would have to put down, such as your standard 3.5% to 5%, or your 10% if your credit score is below, I think it's like a 580, something like that. But it doesn't have to count you out. But at the same time, be mindful that if you have below a 580 credit score and you still want to purchase a home instead of just being patient and waiting, you have to remember that every portion of that loan's lifespan is going to require you to pay interest back on it as long as it is being paid on. So if you don't have a lump sum coming in and it's a home that you can wait on or have built, please just spare yourself all of the heartache and all of the money that you are going to spend. Consider these things. And so I know that many people do not know these things. They aren't taught. It's not going to be something that's going to be in, we would just say, layman's terms, because it will be something. If you do an FHA, you do have to go through a process where you understand certain aspects of it. But at the same time, you need to be mindful that your loan and the private mortgage insurance that is going to be incorporated into that loan is not for your protection, guys. It is not for your protection. It is for the institution that is lending you the money. And so don't be fooled by that. Or the mortgage private insurance, that's MPI. Mortgage private insurance and PMI are similar. And so be mindful of that. Know your different types of loans. And if you have an older home that you would like to do construction to, you don't have to utilize your money out of your pocket. That is a something that's not discussed enough. You can get what's called a 203K loan and be able to incorporate up to a margin price point, the amount that you need to repair the home, and it can all be in one loan. So for example, if you have a home that you're interested in and the valuation is at 350, you can offer that you can offer put an offer in and then get the remainder of that portion in we'll just say a fund for you to be able to go in and write the checks to the contractors for them to be able to come in and do the repairs. And now it still equates to the entire 350, but it can't go over that threshold. Anything over that is going to be required out of your pocket. And so it's important for you to make sure that your offer is going to be under enough where you can get the maximum of what's needed for that repair without going over the appraised property valuation. And so like I said, I just like to share this information because a lot of times we as believers don't have a lot of knowledge surrounding these things. And a lot of times the things that he's calling us to, some people are very, very, I'll just say it, stubborn, and they don't want to share the information. I would never want to sit on wisdom and not be able to share it. And like I said, before I was given this platform, I actually had a lot of knowledge and I would share one-on-one information with people. But this is a better way for me to be able to do everything that I've been given to steward well and manage over well, but still be able to utilize this wisdom and get it out to whoever in specific needs it. So now, for example, with this particular message, I can just tell them, hey, I can send you a video where I actually discuss these matters, and now it's beneficial and it's suitable with the time span in which they need it, which I can deliver it, and with me still having my obligations. But nonetheless, let's jump back in. And so learning the types of loans. So the 203K loan is going to be the one that's going to fall under the FHA, but you have that ability to have a margin of repair funding for we'll just say renovations or repairs. And then you have your standard FHA, which is going to require the 3.5% to 10% based off of your credit and other factors such as your debt to income ratio. Your debt to income ratio is going to be looked at very extensively when you go to apply for a home. And so what that means is don't go out and buy a vehicle. Don't go out and just spend lavishly. Don't go run up your credit cards. Don't just pay them off immediately before you go and apply either. Because while it will boost your credit score, what you do not want them to see is your inconsistency and inability to be able to pay for things on time consecutively. And so when you have consecutive payments coming in on time, they say, hey, this is not really a high risk person. This is unfortunately how they do it. They don't care why you had to max out your credit card. I'm just being honest with you. They don't care that your kid had a health ailment or that something unexpected happened, that you had a loss in the family. They don't care about that. Now, where sometimes they will say you can, submit a letter with special, with special circumstances and you have the ability to explain that, it's not a guarantee, because at the end of the day, the institution is a lender. You're the borrower. And so you don't want that institution to, you don't want to think of them as a person or a person with a personal connectivity, because they don't have one. It is strictly business. This is why when you have little old grandma that's lived in her house for 29 of those 30 years of her mortgage, and then her husband dies unexpectedly and they foreclose on her home. If it was not a business transaction, the humility, if you had humility and you practice from a level of humanity, you would allow grandma to stay in, and then you pull together and figure out how you're going to pay for it for her. That's not the case, guys. So don't get this confused with it being something other than a business transaction. And so your debt to income ratio, you're going to want to make sure that it is where it needs to be. You don't have excessive amounts of things owed. You don't want to have too many payments on things, whether it be like medical bills. Well, medical bills are now, that's a little bit different. But we'll just say your credit card bills or other loans that you may have, student loans, things like that, that you are actively paying on. Because what that's going to do is it's going to cause the amount that's going to be left available for you to utilize towards your home at a very, very low ratio. And so you want as much of that open to what you need to be able to afford the home that you desire, that you've considered. And I pray that this is a scriptural consideration, not just going and being lavish and just kind of just going all in because you just want to be flashy. That's not what we're saying. But for what you've considered that you've needed, you want to make sure that debt to income ratio is appropriate for that. And so after you've done that, that's going to give you an idea of what you can afford. And I'm going to give you another tidbit. Do not, I'm going to say this with an emphasis, do not go and max out on what they tell you you're approved for, because they're not looking at your net. They are looking at your gross income earnings. That means your money or your finances that are coming in before your taxes come out. You should not be utilizing money that you're not going to even see as your margin of where you can afford a payment from. This is the same thing they do with cars. This is the same thing they do with houses. This is the same thing they do a lot of the times with loans, predatory loans. And so, like I said, this is not a partnership, guys. I don't care what they may advertise it as. It's not a partnership. You need to be mindful and you need to know the truth regarding home ownership. And so, you need to base it off of your net. Out of your net, what things do you have to pay from that bottom line dollar that comes directly to your bank account or goes in your pocket? What is that number times 4 each month? That's going to be how much income you're bringing in. Don't go by the gross. Don't go by the gross. And so if they ask you about it, yes, they will approve you for something much greater, because that's the formula that they use. However, you're going to calculate your net earnings, and that's what you're going to base your affordability for your home off of. And like I said, you don't have to be pressured into it. They are going to, probably fight you back on that. You have a little bit more of a margin to be able to get something nicer. No, I know what I can afford. And you stand on that. You stand on that and the resources, and you're allowing yourself that safety net, because like I said, there are other things to consider with a home. You have the maintenance. You're going to be responsible for that. You're also going to have your warranties and things like that you're going to want to have in case leaks and plumbing issues take place, in case your roof, something happens to your roof and you don't need to file an insurance claim. If a hailstorm comes, then yeah, you can do that. But if you have warranty and it's only like maybe $1,500 worth of work, do you really want to file an insurance claim? Because that means that your premium's going to go up. So yes, it's the same thing as an auto policy. If your premium is there and you file a claim, it increases. It's no different for your home. And see, these are the things that aren't being talked about. Your premium will go up if you file a claim. And then when you get ready to resell your home, depending on the amount of that, it's so beautiful. Depending on the amount of that claim, you are actually going to now require just more. You're going to require more, because now you have to list that within your disclosures when you sell your home. How much of that was it at this percentage? Was it at least 10% of the sales price? If so, then you now have to disclose all of that, because it's that could be a problematic area with this particular home, and you have to be fair. And so once you take ownership, that's another key point. Once you take ownership of the home, you are responsible for everything that home has and requires. And so you have to learn the different types of the loan, learn what the process of each type of loan is, and weigh your options to determine which is most sufficient for you within that debt to income ratio, utilizing the net versus the gross, opposite of what they're going to tell you as a lender. And then the next point is, don't fall victim to asking the lenders what's best. They don't work for you. They are the lenders, and they want to capitalize off of your deal. Your mortgage is going to make them thousands of dollars, guys, if not millions, depending on how old your home is. If it's like maybe 20 plus years, your house has already made millions because of how many times it's been sold. If it's been sold 2 or 3 times, then every time that house is sold, that amount still gets put in their hands. And so you're capital to them. This is how they are able to fund the loans that people go and get, because you are giving them this opportunity through the interest that you pay. So of course they're not going to tell you something that's going to negate anything that's going to be an increase for them at their bottom dollar. And so your mortgage will make them thousands of dollars, and if you default, they will default. They will default regardless of how heartbreaking your circumstances are. And that's why I use the example of the grandmother. And so just remember that. And so as far as other things to consider, you should consider the things will happen at some point in time. And it's life, guys. You are going to have unexpected occurrences to happen. So if you are putting everything that you have into a home, guys, just reconsider it and don't do it. I don't care if you've already put in the earnest money, which we'll double back to in a minute. But with the expenses, it's a lot for people. And I can't tell you how many people have gone through certain circumstances and used everything that they had to pour out into a home, and then they're left with nothing and have to restart. And while there's nothing wrong with you restarting, it should not ever come from you doing it to yourself. And so, like I said, with home ownership, you still have to consider that things are going to happen unexpectedly. Do you have enough margin and cushion room? This is why you do the net proceeds versus the gross. Because if you do gross, you're already setting yourself up for failure, because you're going off of something that you don't and you won't ever have access to. And so, back to one of the fees that could potentially come back to bite you is the earnest money when you're actually considering and during the purchasing phase of home ownership. Your earnest money is going to be determined by the community that you choose, the amount that the property is going to be purchased for, and what that buyer says they want. And it's usually anywhere from 1 to 5% of the sales price. So if you have a home that's $500,000, 1% of that is going to be $5,000 off rip to just give them like a deposit. That's 1%. So then if they say 5%, what do you think that's going to be? That's right, $25,000 out of your pocket to put it into that account. This is not including your closing costs. This is your earnest money that's just up front that goes directly to them like a down payment. And so then you still have your appraisal, which is going to be determined by the square footage of the home. And then the other factors, such as, do you have a crawl space? Do you have certain areas that have to be accessible? Are you looking for the mold detection? Are you looking for moisture? Things like that, which could be an additive. So it's not just going to be a standard set fee, but it's going to be based off of the type of home that you have and the actual quality of that inspector's services. So you can pile them on, and I suggest that you do them all, because this is an investment. You don't want to ever just cut corners. And so with your and I'm sorry, I'm getting mixed up, but your appraisal is going to be, just an overview of how much this property has been assessed at. What I'm referring to is the inspection. The inspection process is going to be something that you want to go extensive on. It's going to check for structural damage. It's going to check for like your roofing areas. It's going to check for foundation, your structures. All of those components are going to be there. And then your plumbing. There are three main categories that they look at, and that's your roofing, your structure, and your plumbing. All that can cause like major catastrophic occurrences and just basically kind of cause problematic areas for you, and you don't ever want those type of problems with a home. And so you have to consider those things, guys. And then in considering that things happen unexpectedly, you know, like I said, the PMI or the MPI, you don't get to do away with that. You don't get to do away with your taxes. And we know as time goes on, things increase in valuation more so than decreasing. And so you have to be mindful of that. Your taxes are incorporated into your mortgage sometimes. And if you choose this option, your payment may be $3,000. But if your taxes go up within 6 months and say a home in your neighborhood sells, because that's how your valuation typically is going to be elevated and determined and appraised, your taxes are going to go up extensively. And so you don't want to have yourself bottom out or max out at 3,000, and then 6 months down the line, a house on your block sells, and now there's an increase for your mortgage by $500. Now you're upside down and you don't have enough income. This is why you do net proceeds over gross proceeds. And so because your PMI doesn't go away, your MPI doesn't go away with an FHA. And then with your conventional, you have to pay a certain percentage, or you have to refinance in order for it to go away. But check with your lender and see what options you may have available if you do have a conventional. If you don't, then you can basically have your FHA bought into, you can have it converted into a conventional. But there are requirements such as your credit, the down payment again. So yes, you have to pay another down payment to restructure your loan. And then you have new closing costs. So it's like purchasing your home all over again just to get out of the MPI. So like I said, it's a lot of factors to consider before you even get started. So take the time to do this instead of counting yourself out and making yourself feel like you're behind, because it is a very, very big investment. It's a big decision that you would make. And it's not all that it's cracked out to be. Home ownership is not for everyone. And like I said, especially if you don't have the financial stability, stop trying to force fit something that others think you should have, and they're not the ones that's paying your bills. And so if you don't understand these areas, or if you still have areas that are in question, then you need to take the time to research and do those and find the answers to those questions, because you don't ever want to go in blindsided by something and being ignorant about it. And so like I said, the PMI and the MPI does not go away. It's not an insurance designed to protect you, but it's designed to protect the lender. And so, you know, if you have the inability to pay, regardless of the reason, like we stated, it protects the lender. They're going to get their money one way or another. You know, they protect themselves. So don't exhaust all of your savings on a down payment. We'll just say $100K at the length of a time it took to acquire it, instead of allowing the type of mortgage that will allow a fund for repairs. You know, if you have $100,000, don't go and max out and use all of your money on a down payment. Get something that's going to at least allow you to have at least, I would recommend 30% of that being in reserve, because you always want to have an emergency fund. And if you have exhausted your emergency fund, look at your budget and see where you can kind of cut down expenses in order for you to replenish it and to start to pour back into it. And then outside of that, you know, you're going to come out cheaper in the end, because the less house you buy, the less interest you're going to pay. The more of a house you buy, the more expensive it is, the more interest you're going to pay, depending on your down payment. And then negotiate with the seller concessions. That's another thing that most people aren't aware of. You can negotiate your seller's concessions if you are buying. Ask them if they want to contribute a certain percentage towards your purchase. If they don't, that's okay. you still try to figure out what areas can be contributed. Even if it's like $5,000, take the $5,000 because it's not coming out of your pocket. And so keep your emergency fund though. Whatever you do, exhaust all of these options for you to be able to keep that preservation of your emergency fund. That's what it boils down to, guys. And so, like I said, if you guys have other questions, please comment below, and feel free to utilize the link in my bio to reach out, because that is one thing that I do offer as a private service. It's financial literacy, and I wouldn't ever want to see you put yourself in a circumstance or a certain situation that could be avoidable had you just known. And so please take the time to educate yourselves before you make such large decisions and, you know, move forth. And as always, guys, do your research, take it back to our Father in heaven, and don't get out of his alignment. Seek scripture, because a lot of the financial practices that are put into play today come straight from scriptural principles. We talked about this. So it's the same thing with the mortgage. You get a foreclosure, 7 years goes by and you haven't paid it off. Guess what? They forgive it. It's a biblical principle, guys. And so, as always, like I said, our verse of the week is Isaiah 49:16. Remember that he has you in the palm of his hands. And so just take it back to him in prayer and ask him, you know, how to equip you. How can you better equip yourself if this is something that you know your heart desires and that he's been speaking to you about receiving? Well, and so, guys, I do appreciate you guys for taking the time to watch this video to its entirety. I look forward to the next message with you guys. Until then, take care.